Hello and welcome back to my channel. Today I'll be discussing NISM Series 7, Chapter 4, Risk Management. Risk Management Framework. Margining is an important element of the risk management framework. There are various different types of margins which are applicable on trades, such as value at risk margin, which covers all the potential daily losses, extreme loss margin, which covers the unexpected losses, mark-to-market margins. These are the margins that are adjusted on a daily basis for the daily price changes occurring in the market. Delivery margin, which are required for delivery trades. And special or additional margin, which are margins which are expected when the exchange demands them. How these margins are collected. So VAR margin and ELM are paid upfront. These must be paid before trading. Other than that, mark-to-market margin or delivery margin have a deadline of T plus 2 days to be collected. Mark-to-market margin has an exception, which is that if a client has enough initial margin to cover the potential losses, then the broker does not have to collect any extra mark-to-market margin from the client. There are certain reporting penalties. Brokers should report any shortfall or missing margin payment to the stock exchange by T plus 5 days. And the collection method which will be followed will be on the basis of the rules set by SEBI, stock exchanges, or the clearing corporations. So the basic elements of the risk management framework are as follows: margin, liquid assets, base minimum capital, pre-trade risk control measures, and risk reduction mode. We'll be discussing these in detail further. Margin. Margining is a process by which the clearing corporation computes the potential loss that can occur to the open positions, whether buy or sell, held by the member across all its clients. Based on this computation, the clearing corporation ensures that the client has enough liquid assets to cover the potential loss. SEBI from time to time has put in place various risk containment measures to address these issues. In the cash or equity segment, there are three kinds of margins, namely value at risk margin, which covers the potential losses for 99.9% of the days. Other than the 99.9% of the days, there is the extreme loss margin, which covers the loss for these situations. We also have mark-to-market margin. The mark-to-market margin is on the basis of the outstanding settlement obligation of the member. VAR margin is a margin which is intended to cover the largest loss that can be incurred on 99.9% of the days. For margin purpose, securities were classified in three groups based on liquidity and impact cost, namely liquid securities, less liquid securities, and illiquid securities. Script sigma means the volatility of the security computed as at the end of this previous trading day. This computation uses the exponentially weighted moving average method applied to daily returns in the same manner as in derivatives market. Liquid stocks are the stocks which are most actively traded, and these are subject to at least 9%. Then we have the less liquid stocks, which are subject to at least 21.5%. Illiquid stocks. These are the rarely traded stocks. 50% margin if traded at least once a week, and 75% margin if not traded in a week. There are certain special rules for margining of ETFs. So index ETFs, which are broad-based ETFs, for them the minimum VAR margin is 6%. And sectoral ETFs are not included in this relaxation. For Group 3 securities, these shall be monitored weekly, and VAR margin rates shall be increased to 75% if the security has not traded for a week. In case the VAR margin rate is 75% and the securities trade during the day, then the VAR margin shall be revised to 50% from the start of the next trading day. How is VAR margin collected? It is collected upfront before trading by deducting it from the broker's liquid assets. And it is based on the gross open position, which is all the buy and sell positions across all clients, including the broker's own trades. There is no netting of positions across different settlements. The VAR margin is updated at least 5 times in a day, which may be carried out by taking the closing price of the previous day at the start of the trading. And the prices are updated at 11 a.m., 12:30 p.m., 2 p.m., and at the end of the trading session. Extreme loss margin. Extreme loss margin covers the expected loss in situations that go beyond the 99% value at risk margin estimates. The extreme loss margin shall be 3.5% for any stock and 2% for ETFs that track broad-based market indices. And these do not include ETFs which track sectoral indices. The extreme loss margin shall be collected or adjusted against the total liquid assets of the member on a real-time basis. Extreme loss margin shall be collected on the gross open position of the member. For this purpose, there will be no netting of positions across different settlements. The extreme loss margin shall be released on the completion of pay-in of the settlement. Margin for securities in trade for trade surveillance markets. These are upfront margin rates, which include the VAR margin and the extreme loss margin, and are applicable for all securities. And the rate at which the margin shall be set is 100%. MTM margin, mark-to-market loss, is calculated by marking each transaction in security to the closing price of the security at the end of the trading. In case the security has not been traded on a particular day, the latest available closing price is considered as the closing price. In case the net outstanding position in any security is nil, the difference between the buy and sell values is considered as a notional loss for the purpose of calculating MTM. Collection of MTM. The clearing corporation collects MTM margin before the start of the next trading day. MTM margin is collected or adjusted against the cash or cash equivalent component of the liquid assets of the member. The MTM margin is collected on the gross open position of the member. The gross open position means gross of all net positions across all the clients of a member, including his proprietary position. For this purpose, the position of a client would be netted for each of its various securities, and the positions of all the clients of a member would be grossed. In case of security in trade for trade surveillance market, each trade shall be marked to market based on the closing price of that security. There would be no netting off of the positions and set off against MTM profits across two different settlements. The margin so collected shall be released along with pay-in, including early pay-in of securities. Collection of intraday crystallized mark-to-market losses. Intraday crystallized mark-to-market losses refer to the realized losses incurred by a trader during the trading day due to price fluctuations in their holdings. The ICMTM shall be computed for all trades subject to upfront margining which are executed and closed out on the same trading day. ICMTM shall be calculated based on weighted average price of the trades. ICMTM shall be adjusted against the liquid assets of the member on a real-time basis. Crystallized losses at a security level for a client shall be adjusted against the crystallized profit, if any, from another security for the same client to arrive at client level profit or loss. However, there will be no set off against crystallized profit across two rolling settlements. All client level losses, including losses on proprietary positions, if any, shall be grossed up to arrive at member level ICMTM. ICMTM shall not be computed in the case of security in trade for trade surveillance. ICMTM shall be included in the end of day MTM computation. If crystallized losses exceed the free collateral available with the clearing corporation, then the entity shall be put into risk reduction mode. Certain additional margins are applied on volatile stocks. So when is higher margin required? If a stock's intraday price movement, which is based on the high low, is more than 10% for 3 or more days in the last 1 month, then the minimum margin required will be equal to the highest intraday movement in last 1 month. Or if the high low is more than 10% for 10 or more days in the last 6 months, then the minimum margin which will be required will be equal to the highest intraday movement in the last 6 months. For how long does this higher margin apply? For 3 months. Margin continues until the expiry of the derivative contract after 3 months from when it was imposed. And for 6 months, when the margin continues until the expiry of the derivative contract after 1 year from when it was imposed. To whom does this apply to? This rule is applicable to F&O segment. Liquid assets. There is a certain amount of liquid assets that has to be maintained by the broker. So this is a list of the liquid assets which have to be maintained and also the limit of the liquid asset which can be maintained. Liquid assets are valued daily after applying haircuts. Haircuts are the reductions for the losses. Exposure limits on banks. So there are certain exposure limits which have been put on banks. The exchanges limit their exposure to any single bank based on the trade or settlement guarantee fund or the total liquid assets deposited with the exchange. There are certain limits for weaker banks. So if a bank has a net worth which is less than 500 crores and is not rated P1 or P1 plus by any credit rating agency, then maximum 5% of the total guarantee fund or the settlement guarantee fund or 1% of the total assets, whichever is lower, total exposure to all such banks together will not exceed 50% of the PGF or SGF or 10% of the total liquid assets, whichever is lower. So for a weaker bank, the exposure to the liquid assets will be lesser. MTM losses must be paid in cash or cash equivalents. At least 50% of the total liquid assets must be in cash or cash equivalents. Other assets beyond this limit are not considered part of total liquid assets. Exchanges also limit exposure to any single issuer. Maximum 15% of the total liquid assets within the PGF or SGF can be exposed to a single issuer. There are certain restrictions on fixed deposit receipts as collateral. Clearing corporations cannot accept FDRs from a trading member or a clearing member or a bank that is an associate of the same trading or clearing member. So basically, this table tells us the haircuts which are allowed on the instruments by the central government, and this is how the securities are classified on the base of the impact cost. For newly listed securities which are less than 6 months old, trading frequency and impact cost are calculated using the entire trading history of the stock. These calculations are done on 15th of each month using data from previous 6 months. Based on these calculations, the stock will be moved to the appropriate liquidity group starting from 1st of the next month. First month categorization of a new stock. For the first month, a newly listed stock is placed in a group where its market capitalization is equal to or greater than 80% of the stocks in that group. After the first month, the actual trading frequency and impact cost are calculated during the monthly review to determine the correct liquidity group. Corporate actions like change in ISIN. If a corporate action like stock split or merger results in a new ISIN, the stock with the new ISIN is treated as a newly listed stock for group categorization. Calculation of mean impact cost. On the basis of mean impact cost, the stocks are categorized on the basis of their liquidity. So impact cost shall be calculated by taking 4 snapshots in a day from the order book. These 4 snapshots shall be chosen randomly within 4 fixed 10-minute windows spread throughout the day. The impact cost shall be the percentage price movement caused by an order size of rupees 1 lakh from the average of the best bid and offer price in the order book snapshot. The impact cost shall be calculated for both buy and sell side in each order book snapshot. So basically, the thing is that when there is an order size of 1 lakh, the percentage change in the price movement is calculated on the basis of the best bid and offer price, and this shall be done for both the buy side and the sell side in the order book. The computation of the impact cost, the method for computation of the impact cost adopted by the exchange will be disseminated on the website of the exchange. The exchange shall use a common methodology for carrying out calculations for mean impact cost. The stock exchanges which are unable to compute mean impact cost at their exchange shall use the impact cost calculations of BSE or NSE. If an exchange cannot calculate the mean impact cost, it must use the impact cost data from BSE or NSE. A formal legal document must be signed with BSE or NSE to allow liquidation of positions if needed. If an exchange cannot calculate mean impact cost and does not have an agreement with BSE or NSE, it must apply higher margins on stocks as applicable to Group 2 and 3. The exchange cannot classify stocks into Group 1 or 2 without impact cost data. Margin requirements for institutional trades. So for institutional trades in the cash market, they are subject to the same margin rules as trades by other investors such as retail or non-institutionals. For trades settled on a T+2 basis, margins are collected on a T+1 basis. Who pays the margin? Custodians. If the trade is confirmed by the custodian, the margin is collected from the custodian. Brokers. If the trade is rejected and not accepted by the custodian, the margin is collected from the broker who executed the trade. Margin shortfall. This occurs when a trader's margin balance falls below the required level set by the broker or the exchange. If a clearing member fails to maintain the required margin, the clearing corporation can advise the exchange to withdraw the member's trading or clearing rights. This includes withdrawing trading facilities for trading members or clearing facilities for custodial participants clearing through that member. There is also a penalty for margin violations. If a trading member has a pay-in shortfall, fails to meet settlement obligations, the following actions shall be taken. Trading facilities are withdrawn. Security payout, delivery of securities is withheld. This happens if the shortfall exceeds the base minimum capital and the shortfall exceeds 20% of the BMC but is less than the BMC on 6 occasions within 3 months. Once the member recovers from the shortfall and meets all obligations, they are allowed to resume trading. However, they must provide a deposit called fund shortage collateral, which is equivalent to the cumulative shortfall. This deposit must be maintained for 10 rolling settlements and is not adjustable against margin liabilities or eligible for interest. The deposit can be made in the form of cash, fixed deposit receipts, or bank guarantees. The exchange or clearing corporation may charge a penal interest of at least 0.07 per day on the pay-in shortfall amount. Base minimum capital is the amount of funds that a broker must maintain with the exchange. So there are different slabs in which we have divided the base minimum capital. 10 lakh rupees for brokers who are only doing proprietary trading. 15 lakhs for brokers doing algorithmic or only client trading. 25 lakhs for brokers doing both proprietary and client trading, but no algorithmic trading. 50 lakhs for brokers using algorithmic trading along with any other activity. The BMC is meant to meet the contingencies in any segment of the exchange. For members who are registered on more than one segment of the exchange, the highest base minimum capital deposit across various segments is applicable. No exposure is granted against the BMC. The BMC deposit shall be maintained for meeting contingencies in any segment of the exchange. The stock exchange shall be permitted to prescribe suitable deposit requirements over and above the SEBI prescribed norms based on their perception and evaluation of risks involved. Minimum 50% of the deposit shall be in the form of cash and cash equivalents. For stockbrokers of exchanges not having nationwide trading terminals, the deposit requirement shall be 40% of the above said BMC deposit requirements. Stock exchanges shall maintain the BMC at rupees 1 lakh if the average daily turnover is less than rupees 1 crore for any 3 consecutive months. Early pay-in means depositing funds or securities before the scheduled pay-in day. If a member makes an early pay-in of the funds, the outstanding position to that extent is excluded from margin calculations. Once the securities are deposited with the clearing corporation, it is assumed that all margins have been collected and no penalties for margin shortfalls will apply. SEBI has introduced a block mechanism in the Demat accounts of the clients undertaking sale transaction to simplify the EPI process. This mechanism blocks the securities in the client's Demat account to ensure that they are available for settlement. The block mechanism does not apply to clients who have arrangements with SEBI registered custodians for clearing and settlement. Pre-order checks, these are checks done before the trade. So orders exceeding rupees 10 crore cannot be executed in the normal market, and brokers must implement any sort of value or quantity checks based on the client's risk profile. Stockbroker must implement a system to limit the total value of unexecuted orders from the terminal to set a threshold as directed by the stock exchanges. Price bands should be used to limit the upward or downward price movement of a stock in a single trading day to prevent extreme volatility. Price bands do not apply to derivative products. For stocks without fixed price bands, exchanges use dynamic price bands. The dynamic price band is set at 10% plus minus of the stock's last traded price. If the stock price moves too close to the band, then the band can be released in increments of 5% in the direction of the price movement. But in order to do this, a minimum of 25 trades must be executed. Trades must involve 5 different unique client codes on each side of the trade, and a cooling period of 15 minutes is required before relaxing the band. However, price bands of plus minus 10% are used to prevent trading members in the futures. Exchanges are advised to implement dynamic price bands for movement of contracts to prevent freak trades, ensuring orderly trading. Pre-trade checks. Certain mechanisms are used for pre-trade checks, such as trade execution range. Trade occurs only within a set price range based on a reference price. Self-trade check. Orders from the same pan shall cancel to prevent self-trading. Market price protection. Limit market orders to a specified price level for risk control. Kill switch. This mechanism cancels all outstanding orders with one command. Cancel on logout automatically cancels orders when a user logs out. Risk reduction mode. When a certain percentage of a stockbroker's collateral is available for adjustment against margin, but it gets utilized on account of trade, then the stock exchange or clearing corporation shall put the stockbroker in the risk reduction mode. Currently, this percentage is set at 90% of the stockbroker's collateral. Actions taken in risk reduction mode. Cancellation of unexecuted orders. All pending orders are cancelled. Only orders with IOC, which are immediate or cancelled, are allowed. Margin checks for new orders. New orders that reduce open positions are accepted. New orders that increase positions are checked for sufficient margins. If margins are insufficient, the order is rejected. Brokers in risk reduction mode cannot place non-margined orders. The broker is moved back to normal risk management mode when the collateral utilization falls below 85%. The broker cannot place orders using custodial participant codes. Modifications to client or custodial participant codes are not permitted. Trading member level risk reduction mode. Each client's margin usage is checked against their own collateral. If a client's margin exceeds 90% of their available collateral, it is flagged. Total flagged client's margin plus trading member's own margin are compared to the trading member's proprietary collateral. If this total exceeds 90% of the trading member's collateral, then the trading member enters risk reduction mode. Clearing member level risk reduction mode. Firstly, the total margin in excess of 90% of the collateral for all clients under a trading member is calculated. Then sum of all these margins across all trading members clearing through a clearing member are added. Then the clearing member's own margin is added to this total. If this sum exceeds 90% of the clearing member's proprietary collateral, then the clearing member enters risk reduction mode. The risk management framework for derivative segment includes margins, liquid net worth and liquid assets, pre-trade risk control, risk reduction mode, and positioning of limits. Types of margin in the F&O segment. So initial margin is payable on all open positions of the clearing members up to client level and shall be payable upfront by clearing members in accordance with the margin computation as adopted by the clearing corporation. Initial margin for all client positions shall be netted at the level of the individual client and gross across all clients at the trading or clearing member level without any set-off between clients. Initial margin requirement for proprietary positions shall be netted at trading or clearing member level without any set-off between client and proprietary positions. The margins computed shall be aggregated first at the trading member level and then aggregated at the clearing member level. Initial margin requirement shall be based on 99% value at risk over a one-day time horizon. Value at risk margin is a measure of maximum likely price change over a given interval and at a given confidence level. However, in case of futures contracts, span margining is used. Span is a real-time margin calculation system that assesses the risk of a portfolio. It takes an integrated view of the risk in a client's portfolio, including futures and options on the same underlying asset. After that, it considers 16 scenarios of the price volatility changes to calculate the worst case loss. It uses value at risk at a 99% confidence level over a one-day horizon or two-day horizon for futures contracts if mark-to-market settlement isn't possible before the next trading day. Margins are calculated for the entire portfolio, not individual positions, to account for diversification benefits. Margin period of risk. SEBI has advised clearing corporation to estimate the appropriate MPOR subject to minimum of 2 days. Updation of risk parameters. Scenario contract values are computed and are updated on a real-time basis to ensure that the most recent scenario are applied. The scenario contract value shall be updated at least 5 times in the day, which may be carried out by taking the closing price of the previous day at the start of the trading and the prices at 11:30 a.m., 12:30 p.m., 2 p.m. and at the end of the trading session. A calendar spread refers to taking positions in the same underlying asset but with different expiry months. So, a calendar spread charge in futures and options involves calculating margin requirements based on the delta of a portfolio with contracts in different months. For example, if you have a near month option with a delta of 100 and a far month option with a delta of -100, the margin charge is equivalent to holding 100 near month futures long and 100 far month futures short. This spread treatment applies until the near term contract expires. For index derivatives, the calendar spread charge is 1.75% of the far month contract, and for single stock derivatives, 2.2% of the far month contract. Margin on consolidated crystallized obligation. On an intraday basis, it will be payable on crystallized obligations based on the closed out futures and positions, payable or receivable premium at client level. At the end of the day basis, payable obligations at client level, considering all futures and options position. Net option value is calculated as the difference between the value of long and short positions using the latest closing price or current market price for intraday updates. This value is added to a clearing member's liquid net worth. Specifically, the market value of long options is added to the liquid net worth. The market of short options is deducted from the liquid net worth. This adjustment reflects mark-to-market gains or losses on options positions which are incorporated into the liquid net worth rather than settled in cash. This ensures that the clearing member's financial health accounts for the current market value of their positions portfolio. Mark-to-market gains and losses shall not be settled in cash for options position. Margin shall be levied on lower of deliverable positions or in the money long option positions 4 days prior to the expiry of the derivative contract settled through delivery. If expiry of the derivative contract is on Thursday, the delivery margins on a long option position shall be applicable from previous Friday EOD. Delivery margin at the client level shall be computed as per the margin rate applicable in capital market segment of the respective security. Delivery margin shall be levied at client level and collected from the clearing member in a staggered manner. 10% of the delivery margin computed on expiry 4 days EOD. 25% of the delivery margin computed on expiry 3 days EOD. 45% of the delivery margin computed on expiry 2 days EOD, and 70% of the delivery margin computed on expiry 1 day EOD. Delivery margin shall be recomputed only at end of day basis considering the revised position, underlying prices and margin rates. Post expiry positions which are converted to settlement by delivery margins as applicable in capital market segment shall be applicable and levied as delivery margins. Delivery margin shall be a part of the initial margins of the clearing member. VAR and extreme loss margin are computed in the capital market segment and shall be applied on client level settlement obligations. Delivery margins block shall be released on completion of the settlement. Assignment margins shall not be computed on positions which shall be identified through delivery. Mark-to-market margins. End of day mark-to-market margin shall be computed on expiry and expiry plus 1 day as difference between delivery obligation, between settlement obligation and value of positions at closing price of the security in the capital market segment of the exchange. Mark-to-market loss in one security shall be netted against profit of other security for the same client. Net loss at client level shall be gross to arrive at clearing member level mark-to-market margin. Early pay-in of securities facility by way of block mechanism is available. Extreme loss margin and the various rates of the extreme loss margin on the derivative products. In case of calendar spread positions in future contracts, ELM shall be levied on 1/3 of the value of the open position of the month's future contract. In case of index option contract that are deep out of the money, that is strikes out the money by more than 10% from the previous day closing underlying price, the applicable ELM shall be 3%. In case of index option contracts with residual maturity of more than 9 months, the applicable ELM shall be 5%. In case of single stock option contract that are deep out of money, the applicable ELM shall be 5.25%. Cross margining is a facility introduced by SEBI which allows market participants to use their margin capital more efficiently by offsetting positions in cash market and equity derivatives. This means that if a participant holds offsetting positions in both segments, the margin requirement is reduced. Below are given the eligible positions for cross margining. These include index futures, ETFs, and various other F&O segment products. The positions in derivative segment for stock future and index future shall be in the same expiry month to be eligible for cross margining. In such a case, spread margin of 25% of the total applicable margin on the eligible offsetting position as mentioned above shall be levied in the respective cash and derivative segment. In respect of positions which are eligible for offset in index future contract on eligible equity indices pairs, the spread margin shall be 30% of the applicable upfront margin on the offsetting positions. Cross-margining benefit shall be computed at client level on a real-time basis and provided to the trading member or clearing member, as the case may be, who in turn shall pass on the benefit to the client. For institutional investors, cross-margining benefit shall be provided after confirmation of trades. Cross-margin benefit on offsetting position is also extended for different expiry dates subject to the following criteria. A spread margin of 40% would be levied in case of offsetting positions in correlated indices having different expiry. In the previous slide only we learned that the spread margin applicable for the other case is 25%. A spread margin of 35% would be levied in case of offsetting positions in index and its constituents having expiry date different from the index. If two offsetting positions have different expiry dates, the cross-margining benefit will be revoked on the expiry day of the position that expires first. After this, the full margin will apply to the remaining position. Cross-margining benefit shall be computed at client level on an online real-time basis and provided to the trading member or clearing member as the case may be, who in turn shall pass on the benefit to the client. For in institutional investors, the cross-margining benefit shall be provided after the confirmation of trades. Liquid net worth is the total assets deposited with the exchange or clearing corporation towards initial margin and capital adequacy, less initial margin and extreme loss exposure margin applicable to the total gross open positions at any given point of time on all the trades to be cleared through the clearing member. The clearing member's liquid net worth shall not be less than rupees 50 lakhs at any point of time. Liquid assets are segregated as cash component and non-cash component. Exposure limit for each bank. The clearing corporation shall lay down exposure limit either in rupee term or percentage term of the trade guarantee fund that can be exposed to a single bank directly or indirectly. If the bank is not rated P1 or P+1, the exposure cannot exceed 5% of the trade guarantee fund or 1% of total liquid assets, whichever is lower. For all such low rated banks combined, the exposure cannot exceed 50% of the trade guarantee fund or 10% of the total liquid assets, whichever is lower. Exposure limits and any changes thereto shall be promptly communicated to SEBI. The total exposure of the clearing corporation to the debt or equity securities of any company shall not exceed 75% of the trade guarantee fund or 15% of the total liquid assets of the clearing corporation or house, whichever is lower. At least 50% of the total liquid assets shall be in the form of cash and cash equivalents. Only FPIs are permitted to offer foreign securities with AAA ratings. The clearing corporation cannot accept FDRs from trading member or clearing member if the FDRs issued by themselves or the banks that are associates of the trading member or the clearing member. Margin collection by clearing corporation. The initial margin and extreme loss margin shall be paid upfront by the clearing member. Clearing members are required to collect initial margin and extreme loss margin from the client on an upfront basis. Clearing members shall provide for margin in any one of the eligible collateral modes. Clearing member can deposit liquid asset in combination of various liquid assets in a manner and within a limit as specified by the clearing corporation from time to time. Clearing members shall be permitted to provide own securities or trading member proprietary securities or client securities towards the margin deposit requirement. Clearing members can use their own securities, trading members proprietary securities, or clients securities to meet margin requirements. Client or trading member securities can only be repledged through the margin pledge facility provided by NSDL and CDSL. Clearing member must ensure sufficient collateral is allocated to cover the margin requirement of trading member, constituents, and clients. If the margin requirement exceeds the allocated collateral, the proprietary collateral of the trading member or the clearing member will be locked over the shortfall. This locked collateral is considered deemed allocation towards the client's margin. The allocated collateral plus the value of repledged securities must always be greater than or equal to the minimum margin required for each trading member in each segment. Clearing corporation provide facility to transfer collateral from one segment to another intraday. Release collateral intraday or at the end of the day. Margins from the client. In cash segment, we have the upfront margins, which are the VAR margin and the ELM. These should be collected upfront from the clients by trading members or clearing members. If the trading member or clearing member collect at least 20% upfront margin, they will not face penalties for short or non-collection of margins. However, clearing corporation will still collect the full VAR and ELM margin from the trading member or clearing member. Other margins, which are the non-upfront margin, for other margins, trading members have T plus 2 working days to collect them from the clients. Client must pay these margin as soon as margin calls are made by the stock exchange. The T plus 2 window is only for penalty purposes and does not mean that the client has 2 days to pay the margin. Reporting margins. Trading members must report a single consolidated value of minimum margin, additional margin, and mark-to-market margins collected from clients. They must also report any short or non-collection of margin to the stock exchange by T plus 5 days. Early pay-in benefits. If pay-in is completed by T plus 1 day, all margins are considered collected and no penalties will apply for short or non-collection. If early pay-in of securities is made to the clearing corporation, all margins are deemed collected and no penalties will apply. Penalties and disciplinary action. If trading members falsely or incorrectly report margin collection from clients, the stock exchange will take disciplinary action as per SEBI rules. Collecting at least 20% upfront margin avoids penalties for short or non-collection. In F&O segment, trading members must collect initial margin, excluding delivery margin and ELM from the clients upfront. Delivery margin and margins on consolidated obligation must be collected by T plus 1 day. Trading members must report any short collection of margin to the stock exchange by T plus 5 days. In currency derivative segment, trading members must collect initial margin and extreme loss margin from clients upfront. Margins for consolidated obligation must be collected by T plus 1 day, and for currency future, the final settlement amount must be collected by T plus 2 day. Trading members or clearing members must report any short collection by T plus 5 day. Margins can be collected in various forms approved by SEBI or the clearing corporation based on risk management and liquidity policies. Penalty for short or non-collection of margins. Non-reporting is treated as 100% short collection and penalties are charged accordingly. If a trading member or clearing member falsely reports margin collection, they face a 100% penalty on the falsely reported amount and a 1 day trading suspension in that segment. Co-settlement guarantee fund. Every clearing corporation shall establish and maintain a fund for each segment to guarantee settlement of trades executed. In event of a clearing member failing to honor his settlement, the fund shall be utilized to complete the settlement. The corpus of the fund shall be adequate to meet the settlement obligations arising on account of failure of clearing members or participants. The sufficiency of the corpus of the fund shall be tested by periodic stress tests as specified by SEBI. The utilization of the fund shall be in accordance by SEBI. Contribution to core SGF. Clearing corporation contribution to core SGF shall be 50% of the minimum required capital, which should be from its own funds. Stock exchange contribution to core SGF shall be at least 25% of the minimum required capital. The total contribution from members to core SGF for each segment will not be more than 25% of the MRC of the respective segment. No exposure shall be available to clearing members on their contribution to core SGF. The required contribution of individual clearing members shall be assessed pro rata based on the risk they bring to the system. Clearing corporation shall have the flexibility to collect clearing member primary contribution either upfront or in a staggered manner over a period of time. In case of staggered collection, the remaining balance shall be met by clearing corporation to ensure adequacy of total core SGF corpus at all times. Such clearing corporation contribution shall be available to the clearing corporation for withdrawal as and when further contributions from clearing members are received. As per SEBI circular, the clearing member contribution to core SGF shall be met to the extent available from the amount received from the exchange. Any penalties levied by clearing corporation shall be credited to core SGF corpus. Interest earned on cash contributions to the core SGF will be added to the core SGF and distributed to the contributors based on their share of the total cash contribution. With this, we come to an end to chapter 4, and kindly do like, comment, and subscribe to my channel. Thank you.